really great to be back here. I mean that sincerely, Teresa. I really mean it. Before I start talking about exit planning and really get into it, I'm going to put my glasses on so I can see what I'm doing. And I'm going to find the, okay. My first slide says evolution and overview of exit planning. The time has come. Mike, you and I have talked about this for a long time, haven't we? And the time has come. Let me just give you a little of my qualifications of why I think I'm qualified to be up here talking to you about it, okay? After 17 years with Ford Motor Company and Xerox Corporation, I got into the business brokerage business in 1978. I started and helped start the Geneva office, Geneva Capital Markets, in 1985 here in Chicago. I was with them for about 7 years. They were sold a couple of times during that time, but I met a lot of fantastic guys, including Mike Knoll in California, and here in the Chicago office we had graduates like Bob Billow and Andy Smith and a whole bunch of great people. But I went back on my own in 1992 and had about 4 or 5 people working with me. And we were selling companies that would sell between $5 million and $100 million. Okay, all privately held companies, of course. Then in the year 2000, I woke up one morning, which at my age was just something to do in itself. And thank you. And woke up one morning and I said, you know, I wonder, I know I'm selling our clients' companies for the highest value because of the great way we run an auction and so forth. But I really wonder if I'm hitting my clients' goals and objectives. And the answer came back to me, no. You know why? We didn't have any goals and objectives back in 2000. Everyone was focused on a transaction, and that was the main focus. We didn't have any planning. All the tax planning was done after the liquidity event. All the estate planning is done after the liquidity event. And the financial planning is done after the liquidity event. Duh, is that the best thing for the client? To do all the planning after a liquidity event instead of before the liquidity event? I don't think so. I think we can increase, I've heard different numbers, but we could increase the net value of a transaction by almost 20 to 30% by starting to get into planning before the liquidity event instead of after the liquidity event. So I woke up to that, and I changed our model around completely, and we put exit planning in as the first step. We beta tested it on 3 companies. It worked out real well. We were so successful, we decided, well, we'll write a book on it. We wrote a book called The $10 Trillion Opportunity. That went well, and then we decided we're going to start training other advisors and certifying other advisors in exit planning. So we started the Exit Planning Institute, and that was about 2006, 2007. Since that time, we've trained and certified exit planners in Mexico, United States, of course, Canada, Germany, United Kingdom, and Australia.